Welcome back. Bajaj Finance is definitely going to, be a front and center today. Abhishek is here to tell us why you should be watching that one. Abhishek, good morning.
Well, in less than 6 months, RBI has lifted the restriction that it had placed on Bajaj Finance two key products, that is e-com as well as online and digital Insta EMI cards. BAF had written in Q4 FY24 PPT that they have made request to RBI to lift restrictions after, getting all the RBI concerns done away with. So FY25 guidance that they had given in their PPT did mention that AUM growth is on track for 26 to 28%, while they see net interest margin to decline by 30-40 basis points in H1 of FY25, and they expect the credit cost for FY25 to be in the range of 175 to 185 basis points. So the management had baked in these numbers along with the fact that restrictions will be lifted on their two key products. Now, analysts say that there is not much of an upgrade or EPS expected. However, this can be a positive catalyst for re-rating of the stock. Back to you.
Okay, all right. Abhishek, thanks a lot for that. Let's hop across to Rima. She's here to tell us about Coforge as well as Signet here. Morning, Rima.
Hi, good morning. So yesterday, Coforge reported the Q4 numbers, but along with that, they've announced the acquisition, a majority stake in Signet Technology, also a listed company. So first on to, the Q4 numbers. Revenues were in line with street expectation at 1.9%, but margins have come in lower than expectation. And here the company in the conference call said that some of the newer contracts are coming in at lower gross margins. What's also disappointed the street is that this time the company is not giving an FY25 revenue guidance, a growth guidance. They've refrained from giving one. So that's a bit of a negative surprise because clearly the environment, they're not confident about the environment to put a number to the kind of growth. Now, about the acquisition, Signet Tech, as I said, is a listed company. They're going to be acquiring shares of 54% stake at 1,415. And this acquired company is about 20% of the company's top line as of last year. But brokerages are disappointing. Jefferies has downgraded it to an underperform. They've cut EPS estimates by as high as 11 to 16%. They say continued disappointment on margins, weaker growth and acquisition-related uncertainty warrant a derating. And plus, remember, the company will have to do a QIP to fund this acquisition, for which they've already got a board approval. So that's an additional overhang. Nuvama maintains a buy rating, but they've lowered the target price. They've cut the target multiple, and they say that we would have preferred that Coforge had acquired a company with more new age tech domain. Back to you.
All right, Rima, thanks very much. By the way, we have the management of Coforge joining us at 10:40 this morning. So that's a conversation you don't want to miss. We'll talk about, of course, the numbers, which are disappointing, and of course, the acquisition as well. But Coal India is the next one we are focused on. Numbers came through. Nigel.
Well, that's right. Now, Coal India, it could go either which ways, but I'm going with red because it appears on an adjusted basis. These numbers are a little bit disappointing, namely, if I compare it with what Nuvama as well as what Jefferies has written earlier today, and they have been the biggest pulls on the stock. So one point you need to note is that now they've accounted for these numbers, with regard to change in the way they account for the stripping activity. So that's important. So that's the broad numbers that come up for you on the screen. Adjusting for the stripping activity, well, the margins go up to around 26%, but the absolute number is around 9,840 crores. Some on the street were anticipating a number above 10,000 crores out. So that was a bit of a miss out there. Realizations, well, that was a little bit weaker. On the e-auction front, well, it came in at around 2,545 odd. The street is expecting a number of close to 2,600 rupees per ton. So that's a 2% miss out there. And the FSA as well a little bit weakish. So that was a bit of an issue. The e-auction premium to FSA sales, that's come down to around 66%, but that was more or less on expected line. So the stock could open up in the red because it is a bit of a miss in comparison to certain estimates. Though what supports it is that they declared a dividend yet again of around 5 rupees, 25.5 rupees for the past year. Starts in the red. I won't be surprised if it recovers. Vivek joins us though to tell us about Yes Bank. Vivek, morning.
Well, good morning. Yes Bank will be in focus. We are anticipating a block deal to take place in the stock today. So sources indicate to us that Carlyle is set to sell close to 2% of the total equity. The total size of this particular block could be close to 1,500 crore. So that could remain an overhang on the stock in today's trading session. Now, remember, after the conversion of warrants, that were issued to Carlyle, Carlyle now owns close to 8.7% stake in Yes Bank. And this particular stake is held by an entity called as CA Basque Investments. We understand from our sources that Goldman Sachs is the broker to this particular deal.
Okay, thanks a lot for that. Ajanta Pharma reported a good set of numbers. Ekta is here to tell us more. Ekta, over to you.
Thanks for that. Well, yes, revenue was up around 20-odd%. Margins were at 26 versus 17%, and the profit was higher by around 66% on a lower base as well. It was higher than expectations. India did well. It's around 31% of their business. It was up around 14%. US generics, which is around 23% of sales, was up around 32% for the company this quarter, year on year. Africa institutional was up 23%. So all of these segments did very well for them. And in terms of guidance, they expect the domestic business to grow 10 to 11%. They're expecting 6 launches in the US in FY25, 8 to 12 ANDA filings in the US in FY25 as well. So overall, good set of numbers. Expect the stock to be in the green.
Okay, thanks a lot for that. Well, I'm looking out for 2 stocks, CEAT and JBM Auto. JBM Auto, let me start with that because I'm expecting a bright green over there. Very strong numbers coming through from that company. A revenue growth came in at 47.1%. It was led by a strong growth in the EV bus division, which saw a growth of almost 3x year on year in the revenue. So the EV revenues last year were about 222 crores, and this year the EV revenues came in at 631 crores. So that's pretty much what led the jump. The overall margins also went up about 100 basis points for JBM Auto, and as I said, a total revenue growth of 47%. Core EBITDA went up 60.4%, and the net profits went up 120%. So that's about JBM Auto. The other stock I'm looking at is CEAT, and I'm going with red over there. I'll tell you why, because the revenue growth for CEAT was in low single digits. Barely a 4.1% growth is what the company saw. The EBITDA margins were actually impacted by higher other expenses that was led by EPR related provisions. Now, EPR is the extended producer's responsibility, which is the requirements that are imposed on the tyre industry by the government of India. So that led to higher expenses, and that then hit their earnings. The profits actually fell 23% for CEAT, and the margins came in at 13.4% versus 13.1% same time last year. So barely any margin growth going for red over there.
Okay, all right, Sonia, thanks a lot for that. Well, in fact, we have the management of JBM Auto as well later today at around 10:15 a.m. So stay tuned for that conversation. But Vamakshi joins us to fill us in with a couple of more numbers that came out overnight. Hey, Vamakshi, morning.
Well, good morning, Nigel. Let me first start off with KEI Industries. A mixed set of numbers is what the company has reported this time around. Revenue was 2% above, EBITDA was in line, but net profit was 3% below what the street was expecting. Now, revenue saw an uptick of almost 19% on a year-on-year basis, and this was largely led by an 18% jump in the cable and wire business and a 53% jump in the EPC business. But this was partly offset by a nearly 11% decline in the stainless steel wires business. The margins have improved by 20 basis points to 10.5%, and this improvement is largely being led by the cables and wires as well as EPC projects. Net profit has come in nearly 22% higher, and the order book stands at a healthy 3,500 odd crores. So going with a mild green for KEI Industries. Apart from that, keep an eye out on Raital. The company reported steady revenue growth. Revenues have seen an uptick of almost 24.6% sequentially. The margins, however, have declined on a quarter-on-quarter basis from 17.8% to 14% and are flat year-on-year. Net profit, nevertheless, has seen an uptick of almost 24.8% sequentially. So going with a mild red for Raital as well.
Okay, here's a quick recap of our top stocks. Stocks with positive news flow: Bajaj Finance, Cigniti Tech, Ajanta Pharma, JBM Auto and KEI Industries, while stocks with negative news flow: Railtel, Coal India, Coforge, Yes Bank and CEAT. But